Okay, so you asked me this last episode. What's your order? What's your top 5?
Well, so
winter.
So remember, I was lockstep
boozes.
with you pretty much all the way until you said rum. So Scotch, number 1. Scotch is my number 1 year round. So I'm sorry if that disappoints anybody. And then 2, rye for the winter. It changes with Irish whiskey. So Irish whiskey in the summer takes the lead over rye, but in the winter months, rye gets the edge. So it's 1 Scotch, 2 rye, 3 Irish whiskey, 4 bourbon. But
okay.
I wouldn't say no to either at any point.
No.
All 4.
No, absolutely, right?
And I'm sorry. I feel like I need to diversify, though. Like, it's all just whiskey. So maybe, do I need to diversify? What do you think?
It's because that's just the wheat prices and the wheat futures, the grain futures making you go like, ooh, I need to.
What about sugarcane futures? Did you know that over $5 trillion exchanges hands on a daily basis? That's an average of over $220 billion an hour. Now, how does this much money move every single day, and why does it move the way it does? Here on Drunkenomics, 2 bartenders who also happen to be students at the University of Nebraska Graduate School of Business are going to sit down and drink to the global economy and try and translate it into English. So sit back, relax, pour yourself a stiff one, and have a drink with us to the comedy that is the global economy.
All right, guys, and welcome back to part 2 this week of Drunkenomics, the drinking podcast with an economics problem by the power of, I don't know what it is this week, the VIX, rum, temperature,
Scotch, Metallica cigars, whatever.
I think I've just, should we even check?
No, that's why. Why waste your time? It's, I have it on the quick lookup on my phone. It's on my screen saver right now. The VIX closed at 21.14. So yeah,
closer than it's been in the past. But I remain the undisputed host of grace, your more gracious host, James Goldwater. And then over there in Arizona, weighing in at 193 pounds of silent steel and sex appeal. Is that? Am I close?
No,
I don't know what you weigh.
Dude, I'm freaking light, man. I weigh like 170 now, dude.
Okay.
Dude, I'm tiny.
Then joining me from Phoenix, Arizona, weighing in at 175 pounds of silent steel and sex appeal, your main man, the less gracious Aaron Wong.
Oh, thanks. I love that intro. If I ever do end up doing amateur boxing matches or whatever like that, I really hope that you're the one. It's
funny, guys, because he's been going to a boxing gym to work out. That's why I'm doing this.
Dude, I love that. Where it's seriously like, if you want a hangover cure, go boxing. It's the best. It's seriously. It's
a great workout.
Yeah, it's not financial advice. I'm just saying, and none of anything we say is financial advice. Just so you know, nothing like we say reflects the views of our employers or anything like that. But I'm just saying, me personally, my thoughts only. I think boxing, when you're hungover, that'll wake you right up, man. That'll just cure the hangover instantly.
My view is, I go a little bit differently. I'm either all about the pho or the hair of the dog. So maybe both.
Okay. I think so your best hangover cure beats my best hangover cure by a lot, actually. So I'll give you that much. And that's why you're more gracious.
But yours is a lot more productive. Yours also has other benefits to the body.
I know, but then again, yours also, like pho, like think about how many benefits pho brings you. A lot. And
pho's always
hair of the dog.
I'm going to say that.
Yeah, I know. Hair of the dog has its benefits, but it's really short term, right? So.
But it can also bite you. It can also not be beneficial at all. It really can go one of two ways.
It could literally just, hair of the dog and then now you're going to the bathroom golfing.
Absolutely.
Yeah. Anyways.
All right, so guys, so as we reminded you on Monday, if you want to jump in with us on social media, check us out in the metaverse on Twitter while it lasts. Not if you're a bot, because you're probably gone now. And
let's hope so.
Let's see. So at Drunkenomical, DRUNKENOMICAL.
Yeah.
So that's Facebook, Instagram, Twitter.
God, better than me at that now.
TikTok, I think too, until that bipartisan ban comes through.
Oh yeah, that's pretty fascinating. Like I don't know, like. Did you see what the reasoning for that was? Was it like, was it because China was getting too much data on American consumers?
I think the concern is that there would be too much it could be used to invade Americans' privacy. And I'll be honest, what? As a U.S. senator, you're absolutely right, Marco Rubio. If anyone's going to be invading the privacy of American citizens, it's the NSA and Facebook. You tell them it can't be a Chinese company. You tell them you buy American.
If anybody has the right to invade U.S. citizens, it's America. It's us.
It's
right?
the U.S.
It's the U.S. Exactly. It's not Europe. It's not China.
Yeah,
it's us.
That's exactly.
Oh my God.
And the idea that the Chinese thought they could do it too, unacceptable.
Unacceptable. No way. Can't be approved. Yeah. So apparently the ban's a thing.
Well, there's a bipartisan bill in it, at least. I don't know. It may not get passed.
I mean, let's see. I mean, like, because honestly, I think maybe this is happening because someone at Facebook is deep into the pockets of a lot of politicians on both sides of the aisle. Maybe. I'm not saying that's true. I'm not saying it's not true. I don't know, to be honest with you. I don't know if
I mean it doesn't it wouldn't surprise me.
It wouldn't surprise me if Facebook, Google, if they're all in the pockets of these politicians.
If the FANG companies have been donating money to candidates in order to maintain their positions,
absolutely.
That would never happen in the US.
No, God, why would that ever happen? Yeah, that would be unlike a politician to accept money for more favorable rulings.
Absolutely.
Yeah, that's
too it's blatant corruption, and I won't stand for it.
No way. So I mean that's what's going on.
It's an interesting week. We got some really great numbers today and
yesterday. But before we do that,
yesterday.
I want to wrap up something about the options thing because I know I talked, just like Monday was just a word vomit of options stuff, right? Just a lot of different strategies. Some of the main ones. There were some we left out, like back ratio spreads. There were other things that we left out too. But seriously, you could know all these different strategies. There's so much to know about options. That it's just like the more you know, the more you realize.
Dunning-Kruger, the more you know, the less you know. The more you realize that you don't know as much as you think.
Yeah, that's what I was trying to say. Exactly. Yeah. So bottom line though, like with options trading, is like you can know how to trade all these different strategies, and I encourage you to know all these different strategies. I think it's great. But also, before you ever try any of these strategies, know the risk reward, right?
Yeah.
If you want to try it out in a paper trading account, go crazy. Like, do whatever. Like, seriously, make all the mistakes you can in a paper trading account.
And that would be the way to start.
Yeah.
Like the rule is if you're going to get rich, use other people's money. And the easiest way to not lose other people's money before you get rich is to try it on paper first until you have proof of concept. Until you're comfortable.
Exactly.
Because
so if you want to do a bull call spread, a bear put spread, iron condor, or whatever it is, try that into paper money first. Like, know exactly what you stand to lose, what you stand to gain, all that kind of stuff. It just helps if you understand it. And on top of all that, right, at the end of the day, when it comes to trading options, you make money if the stock does what you want it to do, right? So a bull put spread, the stock just needs to stay above a certain price or go above a certain price if you're doing a bull put spread that's in the money, right? Mm-hmm. The stock still needs to do whatever it is you want it to do for you to make money. So you can know all these strategies, but it doesn't mean you're going to make any money trading options. At the end of the day, your hunch still needs to be correct if you're going to make money trading options, right?
Yeah, no. So what I would say, and this is kind of what Aaron and I were talking about before we started recording, which is it's going to be really hard in options to make money without knowing these strategies, and it's going to be really easy. But knowing them doesn't guarantee that you're going to make money. Just knowing these, it helps, but it's no guarantee. Not knowing them is almost certainly a guarantee to lose money. So it's one of those things where it's like, look,
unless you get like super lucky, like if you don't know how to do a bull call spread or whatever it is, like, and then you just decide to try your luck and see what happens. Like, odds are, you could get lucky. The stock could still move in your favor, whether you knew that it was moving in your favor or not. It could still happen, but yes, like what James said, like it's
really easy to lose money if you don't know what you're doing, right? So it's just
exactly.
So I would strongly encourage you, again, not financial advice, it's your money, do what you want to do. But if you're going to start making a play into options and you're not necessarily certain, or you have a theoretical knowledge, play on paper first, because that's when eventually you'll be making plays on paper and you'll see either your return or your loss. It'll click for you one day and you'll go, I am comfortable using this strategy when the situation warrants it.
Yeah, the more you put yourself in that situation, like, and believe me, like for me, it was one of those things where options were the most confusing thing in the world. And then all of a sudden I kept doing it. Like, I kept messing around in paper trading accounts. I kept blowing them up. I kept, graphing things out. In Thinkorswim, there's a lot of, now like analyze tools and stuff like that are great. And I just kept doing it over and over again. And all of a sudden one day it clicked, right? It just like all these strategies made sense to me. So I encourage you to do that. Seriously, if you're about to put on a trade in a paper trading account and you just want to ask me or ask James what it looks like, if you think it's a good move, obviously if you're going to pitch a trade to us, let us know if you feel bullish or bearish on the stock, or if you think the stock is just going to stay sideways. Post a picture of it, a screenshot in our Discord. We'd be more than happy to talk it over and go from there.
But you can find the invite to that Discord in any of the social media we've already listed. So That's where you find it.
Yeah,
This is your first time with us.
Anyways, yeah, welcome. But yeah, anyways, with that said, I guess, enough about that. Let's move on over to the news. What's new? What's new with you this week, man?
My ankle hurts. I think it's going to snow. No, absolutely not. No, we got the CPI numbers out.
The grocery store.
We got those CPI numbers out this morning. We got the CPI numbers out yesterday. We got the Fed report this morning.
Yeah.
We got and then we did get Chinese retail and industrial data just tonight, just now, because we're recording on
literally just about
the 14th, is it?
Wednesday 14th. I think it's the 14th.
Wednesday the 14th.
Yep, it's the 14th. Just confirmed. So earlier today, was it this morning or was it the afternoon? It was the afternoon for me because I'm in Arizona and everything happens later in Arizona. But so
it was midday.
Whatever. Like it basically midday today. Whatever. Jerome Powell came out with a big Fed decision. I mean, everybody's watching the Fed now. So I mean, if you didn't see it, I mean, odds are you just probably weren't looking for it or were too busy. No harm, no foul, but here it is. The Fed raised interest rates by 50 basis points.
Which I would say is harm and foul. That
is harm and foul. I'm saying if you didn't see it, it's no harm, no foul.
I know, that's why I'm saying that is harm. This is the harm and foul. This is actually the Fed.
There we go, yes. That would be the harm and foul, yeah.
Yeah.
So remember when earlier this year, and I said this, in previous episodes, but remember earlier this year when the Fed, or when Jerome Powell was like, our number one goal for this year is to attack inflation. Well, I don't know, man. I've really questioned, the sincerity of that statement. I really think actions speak louder than words. I live by that, even though you wouldn't believe that I did, but I do.
They're usually pretty good indicators. And I'll say this, Jay Powell is no Paul Volcker.
Yes, he's no.
That's for certain.
I mean, I don't know. I feel like nowadays there's too much scrutiny whether you if you're a Fed chairman, you can't do anything right and you can't do anything wrong, because what if they brought it from practically zero earlier this year to what's it at now? 4.5.
And from about 0 to 4.5 now.
Yeah.
It's the highest it's been in 15 years. It's the highest interest rate the US has had since 2007, right?
Yeah.
So,
I mean, honestly, right now, you can't do anything right? So the year-end target inflation, or not inflation rate, but the year-end target interest rate was actually 4.5%. So I think they missed it by about 25 basis points, which really they should have done 75.
They could have gotten there.
I'm in that camp.
They had the power to get there. It was their decision not to, and I think it's a mistake.
Yeah, they were on schedule to do so. Because I think there were two mistakes. There was one. I think it was the March or April meeting or whenever it was. It was one of those meetings.
Yeah, it was March when they decided not to raise at that point.
Yeah. So March they decided not to raise, and then one of the earlier meetings they did 50 instead of 75, which I was like, okay, both of those were not good choices. But it's at the same time, it's you can't really do anything right. There were people that saw this 50 basis point rate hike and they were like, this is crazy.
Yeah, it's the end of the world. Some people said.
Yeah, a lot of bond traders were like, this is insane, right? Standard & Poor's should downgrade U.S. debt. There were people on TV saying that today. So that's what I'm saying. You can't. There's too much scrutiny. The year-end target inflation. I keep doing that. The year-end target interest, if it was 4.5%, what if in their first meeting this year they just went from 0 to 4.5%?
If they'd gone all the way, that would have been that would cratered markets. That would have destroyed everything. That would have been. So
they can't do anything right.
Yeah. That would have been it's very much it's this whole. If you do it right the first time, you don't have to overcorrect, but they didn't, so they're in a position where if that would have been an overcorrection. I still think they're undercorrecting now. Let's put it this way.
Yeah.
We had a great question in the Discord that came through a few weeks ago, and
so we're just getting around to that answer, but it was a fantastic question. Was it you're talking about the Paul Volcker question?
It is the Paul Volcker question. So it's essentially did Paul Volcker work? Did what he did to interest rates when he was the Fed chair, did
back
that
in the
work?
80s, early 80s.
In the 70s and 80s. And I think the answer to that is yeah. If what you're worried about is
yeah. Well,
what I mean is did it crush inflation? Yes.
Yeah. Yes.
It did. So did it cause some other problems?
Well, yeah.
But
yeah, so that's the thing about the whole Paul Volcker strategy was I think in the long run, coming out of it worked because it's when inflation is that rampant, you got to take care of that first. You got to get that out of the way. And right now, our situation, we still have 7.1% inflation. CPI reports came in yesterday, 7.1%, lower than expected. Everybody thought that this was a great thing that happened, that whatever the Fed is doing is working. I don't interpret it that way. That's just me personally.
No, I disagree. Yeah, I agree with you. That's not, that's just slightly, you're only going to lose a foot. You're not going to lose your leg. It's
it beat expectations. Congratulations. Right. Like, it's essentially just like, running a 100-meter dash, and, some guy runs a 100-meter dash in 25 seconds, which is not something to brag about. I mean, I could, walk that. And then you run your 100-meter dash in 14 seconds, which is not a good time. And you're bragging that you didn't get in last place. It's like that. That's what the CPI report is. The expectation was 7.3%. It came in at 7.1%, which, if, by historical standards, still super hot. And if you look month over month, right, you are trending in the right direction. So I guess you can be a glass half full kind of guy. I'm a little bit less like that. Last month over month, CPI came in still 0.4% hotter than the previous month. This month, it still came in 0.2% hotter month over month. So if you look at prices last month compared to this month, or compared to I guess in this context, it'd be, if you look at prices month of October versus month of November, prices are still up 0.2%. So inflation hasn't gone down.
It's increasing at a slower rate than they feared it might. And so it's one of these things where it's like, okay, it's almost like you're watching football and you're celebrating, and you are actually legitimately celebrating, excited. This is amazing news that you covered the spread. You didn't win. You covered the spread. It's like, that really? That's your level of, like, that's now your bar. It's not that you're actually like winning. It's that you're not losing as badly as people think you're going to.
Yeah.
I would say that's not a sustainable position to be in.
No, exactly.
Economically.
Yeah. That's actually a much better analogy than the one that I laid out earlier. But yeah, it's like you're projected to lose by 17 points, but you lost by 14 points.
Yeah. You're still.
Are you celebrating in the locker room? Like, after that? Like, I no way. I wouldn't. I would
argue you shouldn't be. I would argue that you say, like, that on the bus you go, look, we did better than we were predicted, but we still lost.
No, I wouldn't even do you did better, like, because you shouldn't enter into a game with the mindset of doing better than expected. You should enter into a game.
That's to say, you leave the game
trying
going,
to win.
Yeah, you guys did better. You guys did better than we thought. But guess what? Guess what happens tomorrow when we get home? We're going to have to practice again because we need it, clearly.
Yeah, I mean, but if you look at the the whole where inflation is and isn't chart, right? The reason why, if you really look at why it came in better than expected, it's things like used cars.
Absolutely. More durable goods being sold at lower prices. I think, was it electronics, like TVs and computers got
TVs, smartphones, computers, used cars, major appliances, so like refrigerators. How many times in your life are you going to buy a refrigerator? How many times in your life are you going to buy a used car, television, or smartphone?
I wouldn't even say, like, in your life. How many times in a year? Like, how many times in a year do you buy a smartphone? Chances are you buy one smartphone a year.
2.5.
Or one smartphone a year if you're replacing to the newest model every year. But, like, a fridge, every 5 or 6 years? A car every 5 years?
Yeah.
Like the only, like, so looking at, like, the chart of things, like, major appliances are down 1%. Smartphones are down 23.4% in price. Yeah. And so it's like, okay, so we're seeing it's the things that are dragging the CPI down, that are lowering that inflation. It's major appliances, used cars and trucks, computers, car rentals, television, smartphones. Those are things you don't buy all that often, or do all that often.
The only thing I see on the list that, like, the prices have actually decreased is beef, right? Which, I buy that almost every week. Yeah, so I buy that every week. But, like, if you look at other things that you buy normally every week, lettuce, cereals, bakery products,
eggs is up 49.1%.
Yeah, it's up almost 50%. Think about how many things eggs go in. Like, I mean, so many foods. I mean, you bake something, you crack it in an egg.
I mean, that's what it's like butter and margarine. So also dairy products are up 34.2%. Lettuce is up 19.8%. But I think that might be because in the UK, they're buying lettuce just in case the next prime minister ends up being a wash and they need a new prime minister quick. They just put the lettuce in there.
That's a good one.
Those of you that don't remember, when Liz Truss went up towards the end, someone put up a head of lettuce and they said, which will last longer? And the answer was lettuce.
That's like really funny. Like lettuce versus Liz Truss.
Lettuce versus Liz Truss. And it was
lettuce versus Liz Truss. Yeah, that was really funny.
I'll be honest. I'm surprised she lasted as long as she did. I'm not going to say that about the lettuce. I'm not shocked that it outlasted her.
But those are the things that you spend a lot of money on, right? So, or not a lot of money on, but things you buy frequently. Yeah, I buy eggs almost every week. Like, I eat like 3 eggs a day. I mean, that's.
Like,
I'm a growing boy.
Like those of you with pets, pet food is up 15.7%.
Yeah.
Right. It's not just you. It's here's the big one. I mean, going into winter up here, But utility gas is up 15.5%.
Yeah, health insurance is up 13.5%, right? So that's money coming out of your paycheck. If you really think about it, even if it's included in your benefits from work,
it's still cutting
you still
into
have to pay into those benefits.
Eggs are up 49.1, but poultry itself, so just chicken is up 13.1. Energy as a whole is up 13.1%, right? So that's not just the gas utility. It's also now electricity to just turn your lights on.
Right.
Household food is up 12%. So you have to imagine from the perspective of most people now that sitting here and someone's saying, oh, well, inflation is only 7.1%. Well, based on everything we've just listed to you, that you're probably consuming substantially more often than smartphones,
more frequently,
rental cars, or used cars,
TVs, used cars, computers.
Yeah, you're probably going to sit here and be like,
appliances,
and be like, oh, that's not good news.
No, yeah.
I mean, I saw rent. What was rent up?
Rent is up 7.2%. Yeah, so that's what I was going to say is, rent is still up, and like stuff that you said, electricity is up, and not to mention like the energy shortage around the world is still very present. It's even worse in Europe, So if you look over at the ECB, we've been kind of dogging on the Fed, pretty much for the last 10 minutes or so. Like the ECB, I mean, they have pretty much the same exact problems that the Fed has, but multiplied by 10.
Oh yeah.
Right?
Well, their big problem is obviously that the war in Ukraine is happening in Europe.
Much closer.
So that's one problem.
Much closer in proximity.
2, they consume a lot of Russian energy.
Yes.
Products.
So the energy storage is a little bit more severe over there too. The war in Ukraine, a little bit closer in proximity. Their currency is so much weaker than the dollar.
They were also like, if we thought the Fed was late to the game, the ECB was like did not start.
Yeah,
it's definitely like a forfeit when they waited 6 months on top of that.
Yeah, and also their balance sheet is about the same size as the U.S. Federal Reserve balance sheet, if not bigger, and they're unwinding at a much slower pace. I don't even know if they started unwinding.
I don't think they have.
They started unwinding,
or not in a meaningful way.
I don't think they had. At least that much. Like I'm too lazy to look it up right now, but I know at one point they talked about quantitative tightening. But I think they were just too scared of how the real estate market is going to react, why? The Fed obviously, at least they have the balls to not care about the real estate market here in the US.
Which is funny because they don't have the balls to actually take care of interest rates. Now, at the same time, I will say, like, I'm gonna lay them over the rack for this, for not actually, telling markets, no, we're in this for the long haul. You will feel pain in order to prevent inflation from creating worse pain. I will say that interest rates isn't going to solve a lot of these problems. It helps with certain aspects of them.
Yeah. Well, if you actually watch Jerome Powell's 9-minute presser, it's about a 9, maybe 10-minute presser right after, they announced the interest rates. And just so you know, a little highlight from the presser, there is like a very, very awkward page turn, where Jerome Powell's reading his sentence and then it's mid-sentence. And he stops and he takes like 15 seconds to turn a page because he didn't lick at his finger wet enough when he licked it to turn the page.
Oh boy.
Yeah. So there's that. You got to bear through that. But anyways, one of the things he said in his presser, sorry for the sidetrack, is that the labor markets are still way off balance. Right, the supply and demand are just completely off balance in the labor market. Still, labor participation is still super low. And that's what I've been saying. I feel like that's what I've been saying for a long time. Is like,
well, to me that just means
really
that
needs to happen.
To me that says that the market needs to adjust to a new labor situation, to a new labor reality. I think that the thing is, a lot of people died. A lot of people died in COVID. People resigned during COVID and aren't coming back. And then you have a lot of people who went home and decided that the cost of childcare and the cost of other things is too expensive. So they're not going to go back into the workforce. And so if you're going to, I know a few people who have said like, this is what I'm paying my employees. I don't have any problems filling my jobs with qualified candidates.
Yeah. I mean, that's certainly a good argument too, but it's still like, I mean, there are still almost twice as many, or maybe not that much, but let's just say like 1.8 times as many unemployed people that are part of the workforce participation. Our job openings.
Yeah, there's more job openings than people available to film. And the thing is, you have to. And that's what I mean. Like you have to embrace a new reality in the labor market. And so arguing that the old model of the market is correct and not moving your equilibrium point with a supply shock, because right now there's a supply shock for labor, a major supply shock to the left. At the same time as demand has either shifted right or is staying roughly the same, and you can go either way on that one. It all depends on whether you're looking at the whole like the whole labor market or industries individually. But
Yeah,
as a whole, you're
does
seeing.
that make you wonder, like, why are there so many job openings, and why, like, I mean, are people listing these jobs? Are people creating these openings way ahead of?
Well, there's two. There's part of it is there's this idea that these positions are open because you have businesses that are looking at economic information, economic data, and going, we need to produce more.
Really?
And with the government spending and consuming what they're consuming, where they're consuming it, some of that is what's happening there. People are going, we need to produce more because we have.
So it's also where, I guess the other big question is, where are the job openings, which I know is a lot of it's companies like Caterpillar, Lockheed Martin, Raytheon, like those companies have just amassed so many job openings.
Yeah, but if you think about it, a lot of the jobs, so like some of the jobs at Boeing, Lockheed Martin, and Raytheon are I don't want to say non-skilled, but it's technical labor. It's manufacturing of high-tech goods. Yeah. But some of those other jobs are for engineers, physicists, chemists, very, very highly skilled jobs that there was already a shortage of people. And then COVID didn't help that because now those people have a lot of other options that are paying.
Well, so I mean, I don't know. Does raising
interest rates affect hiring like that?
Well, I mean, like if you keep raising interest rates, does it eventually bring it to? Does it reduce those job openings?
Eventually, yes. So eventually, what happens when you raise inflation, when you raise interest rates enough to combat inflation, what happens is it becomes impossible to expand for a company.
Yeah. So I guess really what I'm trying to say is then why not 75 basis points? Because if you talk, listen to your presser, listen to the guy's presser. He's saying, okay, there's still this great imbalance in the labor markets. Also, if you look at inflation, I know it's still hurting your pocketbooks, and our goal is to bring price stability to you so that you don't feel as much pain every time you go to the grocery store, but we're only raising 50 basis points. Which is still, I get it, historically high.
Yeah, absolutely right. If raising rates is the cure for inflation, which eventually it becomes that, it's just, I guess Paul Volcker had to go to 21.5%,
wow,
to crush inflation.
Let's hope that doesn't happen.
I agree with you, but we got to 4% and the Fed started to waffle on it. It's like, really? You guys are only 20% of the way to what Paul Volcker had to go to deal with inflation that was not even twice what this inflation was. And it's like, are you you're saying, oh, I'm going to deal with inflation, but then you do this. And it's like, well, stop.
And you're and you're even admitting that the labor market is if you look at the labor markets, they're still super strong, which really is suggesting to the Fed that there's still a lot of room for rate hikes. There's still a ton of room there for rate hikes.
Or
and if you look at inflation, it's still it's not trending in the correct direction.
It's not. It's still going up.
Yeah, it's not. Which is what I mean. Yeah.
Yes, the rate of inflation increase is decreasing, but the inflation is still there.
Yeah.
No, I agree with you. If their argument is that, and here's the real thing. If I looked at the CPI data, it's the argument we had, or it's not even the argument. It's the discussion we had just now, which is okay. It's a lot of big ticket items. Durable goods are less expensive. The only thing on that list that we were looking at from CNBC was beef and veal, which is consumed more regularly. Everything else is consumed, annually at best. So it's like, are you really suggesting that a decrease in those is going to offset the huge increases in things that are consumed weekly, if not daily?
Yeah.
In other departments, it's that
exactly. So I don't know. To me, I don't. What was the harm? Seriously, how much harm could they have possibly done if they had raised by 75 basis points? Which back in October, back in September, we all thought they were going to do.
No, so the thing is, they couldn't. Based on U.S. manufacturing data, they couldn't have done enough harm. Financials would love it because financials make a lot of their money off of interest. So they love it.
But it's a double-edged sword because it's okay, they make more money, their profit margins get thicker, but the demand for new debt is lower, right? So it's a double-edged sword. But, I think in the long run, at the end of the day, if you look at it,
I would say where we are, we're not at a point where we're going to see. I think we're still on the elastic side of the curve to use. So
you think about it, 4.5%, which is the high end of the range. The target range is 4.25% to 4.5%. The rate for the Fed, that is still historically low.
It's very low for U.S. history.
Yes.
And the idea, and the thing is, they're trying to chase this idea that we're going to go back to 2% inflation. I don't think that's possible. I think we're going to get to 4 to 5. And I think that's where we're going to have to learn to live our lives. Because
I really hope not, but I see your point. I'm not arguing with you.
Because I think
not.
that 2% inflation was kept. I think that it was kept at 2% for as long as it was because wages were stagnant.
Yeah. Well, I'm not calling you crazy because I actually think you're onto
maybe
something.
I am. I could be. This could be another tinfoil hat moment. I don't know.
I think at the end of the day, like really what the Fed can do, like what they really want to happen is they just want real interest rates to be zero or slightly positive, right? Because at the end of the day, like
ideally,
that's what you want, right?
You'd rather someone, instead of investing in
cash,
in an investment account or in cash, instead of going into not an investment account, but instead of going to a savings account where they're basically breaking even with the rest of the world, you'd rather have them out consuming or investing in things that will produce the stuff that can be consumed, right? So it's
usually like, I mean, to your point, it's really just like, okay, so like instead of saving your money, you're either buying U.S. debt or you're risk seeking, so you're going out and buying equities or whatever it is, or buying corporate bonds or whatever risk appetite you have, you're just going to invest accordingly. But I think what the Fed doesn't want is for someone to buy a U.S. Treasury and lose buying power after the term of the investment.
Correct.
Because inflation is just rampant, right? Like that's the last thing that the Fed wants.
So it's absolutely what you don't want.
Yeah.
I mean, but look at it this way. Like if we're really going to I think we've kind of beat this one to death.
Yeah.
Don't worry, we'll be back in January to beat it some more.
Yeah.
but
absolutely.
But that's not the only. It's like that's to pivot without class here. Unlike the Fed, which is pivoting. I mean, just with like as Alice Cooper would say, we might have no class, but they have no principles.
Nice, I love the Alice Cooper reference. School's out, man.
He's touring with Motley Crue and Def Leppard this year.
Really?
And I think he's going to be in Omaha with them in August. So if he is, I'm going to buy tickets.
Yeah.
And if Alice Cooper opens and plays first, I will watch Alice Cooper, and I'll be honest, I'll leave because I just want to see Alice.
No, dude, I'm telling you, you want to see Def Leppard.
I know. If I'm paying, I'm going to stay for the whole show. But like if the power went out right after Alice Cooper was done, I'd be like, you know what?
No,
right.
Dude, I'm telling you, because I saw Def Leppard this year.
I'd still demand my refund.
Yeah, but I'm just saying, I saw Def Leppard. Yeah, as you should. But I'm just saying, I saw Motley Crue and Def Leppard this year when they did the world tour with Joan Jett and Poison.
Oh man.
First of all, Joan Jett still got it.
She's amazing.
I've loved Joan Jett forever. Okay, she's the queen of punk rock in my opinion, right? Between her and Debbie Harry, they're the queens of punk rock. Joan Jett killed it. Def Leppard, absolutely extraordinary. Motley Crue, Vince Neil, like does he still got it? I don't know. I don't.
Yeah,
like
so. I said,
Tommy Lee was great.
If the ticket prices are good, I'm definitely gonna go. Let's put it that way.
Yeah. But I mean, seriously, Def Leppard was so good. Like, I went there with my boy Luke Lloyd. We all know Luke Lloyd. He's a friend of the podcast, dear friend of mine. We both were like, Def Leppard was like, dude, Def Leppard was out of this world. Like Joe Elliott's the guy.
It's a good show, but like I said, for me, it's Alice Cooper. Like I was like,
I love Alice Cooper. Don't get me wrong.
You have my attention.
Yeah, but definitely sees Def Leppard. I love Def Leppard so much.
No, I think I was talking to someone on Instagram, and it was this 50 basis point pivot. This pivot towards, and I really do forget who it was, and I'm so sorry.
Is it Ethan Lindau?
I think it was who's like, oh, so is this the soft landing? And I was like, no, this is a belly flop. Dude. This is a belly flop. So
this is a belly flop. But I'll tell you this, man. If you need to belly flop for some reason, protect your belly. Get yourself a nice little Drunkenomics hoodie.
Perfect. Yeah, if you check us out and here's the great thing, we did launch the new merch last week. It is pretty awesome. I've talked about some of my methods for avoiding hangovers, but so can you, and you can actually let that be known because we do have the Hair of the Dog line, which in memoriam of the podcast dog Flynn the dog. So you can have his happy smiling face looks at you with just saying Hair of the Dog, and people that know will know, and people that don't know will just be like, that's a good looking dog, and that's an awesome hoodie,
good looking dog,
or dog bandana, or whatever it is that you've got it on.
It comes in coffee mugs, so you can comes on Irish coffee. Literally Irish coffee, Hair of the Dog. Literally, I mean, is there a better combination?
It's sneaky. No one will know. I would joke. I would say I think it's also on travel mugs, so maybe be a little more more careful, because definitely don't do that and drive.
Yes,
don't do anything illegal that way.
Yeah.
But you could get it to work and maybe no one would notice. It's not what I'm not endorsing that. I'm just saying, you do you. But if you've already got too much swag, if you don't need to protect your belly from the flop, if you don't need to have a shirt that also, if you just want to lay down some facts, lay down some shots so people know what you're about, you've got that too. And there's some other fun ones, like you can check us out at what is that called again? Is it
Patreon?
Patreon.
Patreon.com/Drunkenomics, DRUNKENOMICS.
And you can become a patron.
Yeah, just leave a tip in the tip jar.
Exactly. You can become our Federal Reserve. Just pump some free liquidity our way, and it'll inflate our sense of self-worth and our egos. But other than that, it'll keep us producing, I would say, fine content, but I'll just say content. I want to say this great content, but what I'll settle for is what you're currently listening to.
It exists. Yeah. But no, seriously though, we really appreciate your support. Just listening, we really appreciate that. Just drinking with us, we really love that.
I guess my fair warning is we'll be back next week, the week before Christmas, to do our final podcast of the year. But we are going to take the 26th off, so there will be no Drunkenomics. And I mean, short of something just utterly amazing occurring and us coming off of vacation for 2 hours I should say this, us becoming sober enough during vacation for 2 hours to record
to get re-drunk and
intelligible.
Then record,
Then we're going to be taking that week
100%.
off. So after next week, it'll be in 2023.
Yeah,
before we talk to you again, before we get that drink.
But until then, seriously, I guess Monday we'll be having a drink together again. But until
we'll be back
Monday,
in the studio by next week. You'll be back. But so until next week, just until the next time you're with us, obviously, stay drunkenomical.
Yeah. Cheers, my friend.
Cheers.